Welcome to the Enjoy More 30s Family Finance Podcast, the only podcast dedicated to making life more enjoyable for young families by hitting on the financial topics that tend to weigh on us, stress us out, and distract our focus from simply enjoying life.
Hello and welcome to the 5th episode of the Your Parents' Money Mindset series. Last episode we covered some of the potential headaches that can arise in inheriting assets and some great steps to avoid them ahead of time. Today's episode is titled Step Up, the Gain is Gone, where we'll cover some special rules as they currently exist that eliminates all the built-up gains and the taxes that go along with it from certain inherited assets. I say as currently exist because as of today's spring 2021 recording, the current administration is in the steps of proposing what would be very significant adjustments to the taxable gains code. If and when these get passed in the future, what is covered today would need to be adjusted potentially. You will learn today what you need to know about how the rule is situated currently and what you can do and help your parents to be aware of to take full advantage of it. When I went to Disney with my wife Lauren before we had kids, it was way easier to move around. 2 adults can fly around the parks. We hit pretty much everything over just 2 days. The one thing that can throw a wrench into the whole mix, though, is really long lines for the rides you want to get on. There's this one ride at Hollywood Studios called Toy Story Midway Mania, where you sit down in this cart that they have with 3D glasses on and spin around, shooting in different carnival-style games at the digital screens. The problem was, when we got there, we hit one heck of a line. We were debating what to do. Should we go somewhere else, circle back around? All of a sudden, kind of out of nowhere, this side door opened. A cast member asked how many were in our party. We answered 2, and we were ushered through this door, up the side entrance, all the way to the front of the line. It was a beautiful thing. The current cost basis rules are kind of the same thing right now, where instead of skipping a line, you get to skip all the built-up unrealized gains that may have accumulated over time. So what you need to know is first how the rules currently work. Let's say you bought ABC stock for $100. This is what they call your cost basis, which is just a fancy way of saying this is what you put in of your own money. You put in $100. So now let's say that ABC stock went up to $150. That means you gained 50, right? You put in 100, it's now 150, you gained 50. However, you do not get taxed on this 50 until you actually sell ABC stock. So it's called an unrealized gain because you have not realized it yet since you haven't sold it. So where the stepped up basis rule comes into effect then is if you passed away. The person who inherited the stock gets to step up this basis or step up this assumed price that you originally paid for it to the current value. So they inherit the stock at the current price of $150, and we increase or step up that cost basis number for what you originally paid from the original $100 to the current price of $150 when you passed. So since your beneficiary's assumed cost is also now $150, just like the current price, if your beneficiary sold it today, there would be no tax at all paid on it. This whole concept is only applicable to non-retirement accounts. So just to make sure that's clear, I'll say it again. It's only applicable to non-retirement accounts. IRAs, 401ks, annuities, or any other retirement type of an account have their own taxation rules, and so the stepped-up basis does not apply. So what you can do, again, is ask some great questions to your parents to make sure this is something they are aware of ahead of time. In general, when supplementing income in retirement, the rule of thumb is to first take from your non-retirement accounts, then your tax-deferred retirement accounts, and then from your tax-free retirement accounts. So what that would look like is any joint or general individual account, so any non-retirement kind of account first, then from any of your traditional IRAs or 401ks, basically any account that you put money into and you received a tax deduction when you did that. Then finally from any Roth IRAs or Roth 401ks, which are the ones that grow tax-free. Again, as of today, your non-retirement accounts generally incur the least amount of tax, allowing your traditional IRAs and 401ks, which are taxed at 100% as ordinary income, to delay taking any of those distributions. And finally, your Roth accounts that grow 100% tax-free, to let those grow as long as possible. Now, everybody's situation is different. However, they may have multiple joint or individual non-retirement accounts to choose from. If you ask your parents questions such as, have you ever heard of this stepped up cost basis thing? Did you know that you have accounts that will receive this step up in basis and kind of forgive the tax? Do you consider the cost basis before you choose where you're supplementing your income from? Then you can potentially open up a conversation to make sure they're aware of the current rules. My guess is that you'll be met with kind of blank stares. As always, just provide the information for their own consideration unless they ask for direct input. But you can just say that, hey, I was listening to this podcast on stepped up basis, and so I wanted to pass it along because it could potentially avoid a lot of taxation when people are inheriting assets. I'm sure they don't want to pay taxes to the government unnecessarily, so it again is just help for them. Their advisor should really already be considering all these items when creating a distribution plan for them, as maybe their joint account doesn't have a lot of built-up gains and therefore it should be distributed first, while their individual account might have a lot of built-up gains, so let's delay taking it from there because, if God forbid something happens, all the gains will get wiped away. So a quick summary from today is to be aware that the current rules, again as of this spring 2021 recording, are that non-retirement gains are essentially wiped away for the individual inheriting the non-retirement assets. The second thing is to make your parents aware of this through some of those general questions we touched on, because quite frankly, we find very few people have had this explained to them. Thanks for tuning in today. As always, if you are able to implement what we can cover, then as always, that's fantastic. You have less to worry about than before and can focus more on just enjoying life. If you're wanting help with these things though, or have questions you need help in clarifying, check out the Ask Joe section on the show's website, www.enjoymore30s.com. That's enjoymore30s.com. If you enjoyed this episode specifically, please make sure to subscribe and review us on Apple Podcasts or wherever you listen. There are literally millions of young American families out there I'm trying to reach and help just like you. Clicking a star, leaving a review, it really does make a big difference. The next episode is Inheriting IRAs, More Limited Options, where we're going to cover some recent tax code adjustments that have been approved that drastically changed your options when inheriting an IRA from your parents, and what your parents could potentially do ahead of time to try and minimize the total long-term taxes that will be paid because of it. Until next week, thanks for joining me today, and I look forward to connecting with you again soon.
The conversations on this show are Joe's opinions and provided for general information purposes only. They do not constitute accounting, legal, tax, or other professional advice for your specific situation. You should always seek appropriate advice from a financial advisor, accountant, lawyer, or other professional before acting upon any content or information found here first. Joe is affiliated with New Horizons Wealth Management LLC, a branch office of TFS Securities Inc. and TFS Advisory Services, an SEC-registered investment advisor, member FINRA/SIPC.